Okay, so today we're going to do a question from the ZICA June 2016 past exam paper. Now, the reason why I've chosen this question, it is because it has got now additional adjustments. So we're looking at share exchange in this question. Then we're also looking at the additional consideration in this question.
Okay.
So it has got a cash consideration and also has got share exchange. So it's a beautiful question. It has got a lot of adjustments also. We have about 10 notes in this question. Let me just check them out. We have 10. Okay, you see the notes are a lot. We've got about 10 notes, yes. So it's going to be a very good question. Now, the first things first, every single time, we always go for the requirement. So when you're doing a group accounts question, the first thing you do, check the requirement. The requirement says we prepare the consolidated statement of financial position. Now, I'm not interested in this. I'm interested in the date. The date is 31st March 2015. You see? So we are looking at 31st March 2015. This date is critical. And this is so because it's going to help us do with a lot of things. URP, excess depreciation, things like that. Especially excess depreciation. Fair value adjustments is this date. If it was published accounts, we are going to know that most of the reserves and inventories, current assets are free marks. And then last but not the least, we've been told to describe 3 circumstances in which the consideration for an acquisition may be less than the fair value of the net assets acquired. Now, in the exam, please, every single time you see a theory part, this should be a happy meal. You don't jump to start calculating things when there's something you can explain, because when you can explain something, it is going to be faster and you spend less time. So remember that video that I did on Goodwill? There's a video I did on Goodwill where I did some drawings of the farm, and there was this woman called Mapes and the man called Lusambo. They were buying that farm. You remember that question from Facebook?
Yeah.
We explained the 3 types of goodwill in that video. There was inherent goodwill. What else was there?
There was purchase goodwill and negative.
And negative goodwill. So now this question says you have to describe 3 circumstances in which the consideration for an acquisition may be less than the fair value of the net asset. So what can make you to sell? What made that woman in that video to sell the farm at a price lower than the original price of the assets? What can make you to sell at a price lower than the fair value of the assets?
I think from that video, we saw that she sold less than the net assets. The consideration was less because of the pressure. She couldn't sell at more than, because the pressure was there to sell. So no choice, no way out.
Yes, that is true, Mr. Kafut. So in that video, explain the pressures. We talked about 3 situations. The first one, she was just saying, this is my goodwill. The next one, she saw that the price higher than the fair value, so she made the difference because of the position of the farm, the location, the expense employees, and etc. Now the last one, we called it negative goodwill because she sold at a price lower than the fair value of the net assets. And what you said is true because of pressures. But now, what is also true is that sometimes it could be she didn't even have pressures. Sometimes it could be the man went to buy there who was good at negotiating. Are you seeing that? So sometimes it could be that you just have a good negotiating skills. So you're able to negotiate and then you're able to buy at a price lower than the fair value of the net assets. It could be sometimes. Are you seeing it? And then sometimes it could be because of what is called the, bargain purchase.
Okay.
Yes. So all those things can make you buy or sell at a price lower than the fair value. So remember what we explained in that video. We said if it happens that you sell at a price lower than the fair value, how do you record?
So it becomes a loss.
It is a loss. But for me, who is buying, what am I going to include? What am I going to call that to me? What am I going to record?
So as a buyer, it's just another income which has come. It's not goodwill.
Just other income, negative goodwill. Have you seen that? Negative goodwill. Okay. So, we talked about future bargain prices. Just a price lower than the normal price, so just lower than usual. Okay, so that's the 3 marks. That's what you need to explain. We need to explain those few things there to get that 3 marks. It was just a simple 3 marks, which could have been gotten by explaining that what can make you to sell and etc. It wasn't much of the explanations. So here, if you were to put it in a paragraph form, I think I would give you 4 points to go with here.
Okay.
Number one, we want to say that the consideration given for the business sometimes may be less than the fair value of the net assets acquired. This one may lead to what is often called the negative goodwill. But what you should do where there's a negative goodwill, you should be able to check carefully. Have you seen that? Check carefully the values of the net assets acquired. Why are you checking? You want to check because you may be thinking that you've bought at a price lower than the fair value. Can't those assets have been impaired, you just don't know. So you are thinking you've bought at a price lower, can't you? You've not just done your math properly. Those assets have been impaired. Or sometimes it could be just errors in counting. You are thinking you've bought at a price lower than the fair value. Can't you? What have you done? You've not just calculated properly. Or maybe if you are the person who is selling, you think you've sold the price lower than the fair value. Can't you? You just don't know what you are doing. There are errors. So those must be taken into account. Bargain purchase, we said bargain purchase, this one occurs when a vendor is poor in financial position, and then you need immediate cash. You have pressures, as we put it. You need cash quickly, like that woman in that question. And also, you should be able to anticipate future losses. Sometimes it could be that you are buying from me at a price lower than the net assets of the fair value because of the anticipated future losses. We take that into account. But Mr. Usambo, this item of yours in the next few months is going to expire. This in the next few months is going to be like this. You see, you anticipate future losses, then you're able to buy at a price lower than the fair value. And sometimes, just some liabilities may have been omitted. Have you seen that? Okay. You omit some liabilities, or you understate some liabilities. So you think I've spent less. For example, it's like somebody's there are some issue costs, there's some cost at acquisition, all those direct attributable costs. You don't put them into account. You just count the amount of money that you paid. You don't count the cost associated with you acquiring that particular company. So you end up thinking that you've bought at a price lower. Can't you spend too many expenses without knowing? Yes. And sometimes it could be that the fair values of the net assets have been incorrectly valued. Are you seeing?
Yeah.
So those are the 4 points we want you to go with to get that 3 marks. Okay, so now this 3 marks is done. We've gotten all of it. After we've done more than these 3 marks, we've gotten all of it. So now let's go back to the rework. Prepare the CSF of pitch at the 1st March 2015. So we know it's a SFP. Always, every single time, check the date of the trial balance. The date of the trial balance is when? 31st March 2015. It is just the same as the date of report. Have you seen? This is key. From that now, check the date of acquisition. to know the dip involved. Remember, they are reporting at the 1st March 2015, but when are they acquiring? They are acquiring at the 1st of April 2014. So this is a full year. Have you seen? They are acquiring the whole full year. So this is a full year. It is not a part-year acquisition. It is a full year acquisition. Okay, so first things first. I always prefer to get the free marks before you go anywhere. Mr. Kaput. Hello?
Yes, I admitted myself.
Okay, so what we are saying here, we always go with the free marks. Group accounts has got a number of free marks inside,
Okay.
which we must be able to make use of. So you see, what do we do with the free marks? We simply make the format. And the format for group accounts is not difficult. It is always the same. It never changes. If it changes, initially, no fear, no fear, you'll be surprised. The format is usually the same. Okay, so there we go. So now we have our format there. So what do? We simply get the free marks. We are going to copy and paste this format, just the way it is. You see? So we are going to copy and paste that format. So let's copy and paste this format, and then we pump in figures. Okay. So there we go. That's our format there. So what happens here? We know that this guy is the parent, this guy is the subsidiary, and this other guy is the associate. We simply draw a line here. Then we ignore this guy until later. Further notice, we are going to deal with this guy later. But for now, I want to focus on these two guys, the parent and the subsidiary. So in the exam, mention the name of the subsidiary. Don't just say subsidiary, no, mention the name because the examiner told you the name for a reason. So there we go. We are going to post these figures. So how do we post? We make a format, then we'll be posting these figures the way they are. This guy, other investments, to open brackets, we post. Investment in Strawberry and Apple would not include the investments in a subsidiary on the SFP. We don't include this guy on the SFP. But this other guy, the Apple guy, we include. Have you seen? So we're going to make our format now, which is going to have PPE, Goodwill, investments in Apple, and other investments. Then these ones can just come the way they are. So let's make that format now. Let's make that format. Okay, there we go. It is always important to know how to get free marks before you read notes. It saves a lot of time. So in the exam, please write something like this. You say P, consolidated statement of financial position as at 31st March, as at 31st March, March 2015. Yes, there we go. Now in the exam, please write this one in full to get that 1 mark. Write it in full, not the way I've written here. In the exam, you write in full to get that 4 mark. So now, as you know, every SFP has got assets and liability. So we say assets. Okay. Now, where there are assets, they are what we call non-current assets. So non-current assets, that's why now we are going to bring in those things we talked about. Number 1, we bring in PPE. Number 2, we bring in goodwill. Number 3, what do we bring in? Yes, we are going to bring in investments in Apple. Investments in Apple. Now, this Apple is the associate, remember? Number 3, we bring in other investments because this question has got other investments. One thing you should not do is bring in investments for what? for the subsidiary, you don't do that. Everybody have paid them 48 more exam. So there we go current assets because it means you don't know the principal. So they give you 48 to take you back. There we go. Current assets. Now current assets, you close your eyes here because it never changes. You're going to have something such as inventories, receivable. Every single time that changes. Now, as you know, usually you put what? You put bank and then you bring in cash. Now, with a people just bring them in, you're going to put dash, 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 dash. Got a pad. What else do you bring now? You're going to bring in other equity and liabilities. So let me just make a beautiful line here. Make a beautiful line between. And so the show now goes on. So there we go. We have equity. Equity. Where the changes in equity. Equity. We have share capital that changes. Share capital. We have share premium. Share premium. We have retained earnings. Okay, if there's a reserve, another reserve, all reserves come here. If what gives surplus, ETC will bring them here. I think this question we don't have. So what do we do? Usually it is good custom for to leave a line or two if you're not sure. But for me, because I'm sure, I know the principles, I'm not going to leave a line there. I'll simply go and bring in something else. So what are we bringing in here? We're going to bring in something called liabilities. Now liabilities, they also come in parts. There's non-current liability, and then there's current liability. So we bring in our non-current liabilities. Okay, this one is a free mark every single time. So what do we have under non-current liability? What do we have? We have, let's check from the question to see what we have under non-current liabilities. But the format never changes, it's the same. There we go. Non-current, we have this loan. You see that loan? 7% loan. Can you see that? Can you see the loan?
Yes, 7%
loan, yes. So that's non-current. Then current liabilities, oh, we just have one. We have this. Okay. So what do? We go back and right there. Non-current liabilities, we are going to include there. We have the 7% loan. 7% loan. And then we just have one, fortunately. Then we have current liabilities. Now, current liabilities here, they've just given us a figure, a total figure. They've not told us whether it was payable, whether it was a tax, whatever. They've just told us a figure, which we're simply going to paste here. So now let's begin pasting our figures. So our figures now are like that. So non-current, we have 96. So what do you do here? What you do here, simply bring these ones, open brackets, multiply, so you'll be bringing these ones. More than the 96 plus this guy, you just open brackets. Then you could leave it open, and because there could be something. Remember, we said this guy, we ignore the associate. So this guy and this guy we copy and paste on current liabilities. So I need you to take a screenshot so that when you start posting, you will just be talking figures so that we don't waste time coming back here, back and forth. Upper non-current liability, what do we do? This guy plus that guy, or we just copy and paste. Then retained earnings, remember retained earnings, there's a serious working here. There's a working number 5. It is always working number 5. retained earnings here. But let me not name it number 5 because some people may work it faster than others, which I highly doubt. And then so there's a working here on retained earnings. Then equity. Under equity here, see the price is 1 quarter. Always know that the price is 1 quarter and the equity is 120. So this one, what we are going to do, we only pick the 120 and open brackets plus sum that is going to come. We don't pick this one. For the subsidiary, we don't include in the SFP. We only pick for the parent. We only pick for the parent. So when you go to step-up acquisition, you're going to talk about something on this one later on as we advance to other advanced involvements. Okay, so we pick up this one. So what do? We go to total current assets now. We go to receivables. This guy plus this guy. Please get a screenshot, Mr. Kafuti. Then we also get this one. This guy plus this guy.
I've captured.
Okay. So what do? Now we are going to get also PPE, this guy plus that guy. See? Yeah. Now investment in strawberry, we said for the subsidiary, we don't include in the SFP. But for this guy, the associate, we include. So we put a line investments in Apple, we're going to open brackets. We don't know how much was it in Apple. Then other investment is 78. We're going to open a bracket plus or minus something. We don't know. So let's go and post our figures, then we can move on. Okay, so let's go. There we go. So what do we have under PPE? What's our figure for PPE? PPE, we open our brackets there. And we are going to have something here. So we open our brackets, PPE. We have 220,800 plus what? 220,800 plus 124,800. We don't close the brackets, we leave it open in case something comes up. For Goodwill, as you know, there's a serious working here. So we include working here. Okay. Investments in Apple, there's a working also here. You see? Here, there's a working. Other investments we've been told there in the question. It is how many? 78. Now this 78,000, we seem to open a bracket, say 78,000. And then we leave it open in case something comes up, plus or minus, we're going to add here 78,000 there. Inventories, what do we have? What do we have on inventories? What's the value of inventories, Mr. Kafut? Hello?
82,800 plus 74,400.
82,800 plus 74,400. 400. Good. Receivables.
38,400 and 18,000.
So we're not closing the balances. For the bank, do you have anything on the bank? No. Nothing. Cash?
No.
Nothing. Okay. Let's go to share capital. Remember what we said? We said for share capital, we only pick for the parent. That 120,000. What is saying? We leave it open plus or minus, just in case something comes up. Share premium. What do we have on share premium?
300 and the share premium.
Share premium is a working. Are you seeing? So what we do, we don't bring anything in. Share premium simply say working. The reason why there's a working on share premium because they've issued some share exchange. There's some share issues. Retained earnings, what did we say? We said there's also a working here on retained earnings. There's a working. So what do we do? We simply open the brackets. Non-current assets, non-current liabilities, yes, we have. We have two. Which one and which one?
We have got the loan notes, which is 60,000 plus 12,000.
1,000 plus 12,000. And then current liabilities. So current liability, we just have a figure. They've not told us whether it was payables, but we know payables is inside here. So anything to do with payables are coming to add and minus. What figure do we have there?
We've got 96 and 5,400.
Okay. Okay, plus or minus. We've posted our free marks. We've made the format, we've posted the free marks, and our work becomes easier like this. Then let's go back to the notes now. Now, remember, when you're dealing with group accounts, it is always best to start with what we call working number one, and it is called the group structure. Working one. So, working one is the group structure. Okay, such a beautiful working. Now, the group structure, remember, we've got three things in this one. So how do we make the group structure? We have three items. So let's go back to the question. Now we make the group structure. Okay. So let's go back to the question. So we do our group structure. Okay, there we go. Now we have something that we can talk about. So there we go. We've got this beautiful paragraph here. So we've been told here that on the 1st of April 2014, P, a public listed company, acquired 36,000 equity shares in S, the strawberry, by an exchange of 2 shares in peach for every 4 shares in strawberry. Are you seeing? 2 shares in peach for every 4 shares in strawberry. Now, there is a share exchange here, Mr. Kafuti. So we are going to do a working. He acquired the 2 shares in peach for every 4. So 2 shares for how many? For how many? For 4. We are going to work this one out. 2 for every 4. 2 for every 4, which is a good thing. 2 for every 4. Okay, so 2 for every 4, yeah. 2 for 4 shares. Okay, in strawberry. Then plus how much? Plus 1.2 kwacha per acquired strawberry share in cash. So there are different kinds of payments here, if you're able to see. Number one, we have a share exchange. Are you seeing? Then number 2, we have a cash price of 1.2 kwacha per 1.25 kwacha per share acquired. There's a student from Facebook whose name is Lawrence. His name is Lawrence. Lawrence, what is the other name? His name is Lawrence something. That is Lawrence Kawesa. Yes, he sent a message to our inbox requesting that we do this for him. So I'm going to tag his name when this is done so that he can also be able to see. So now here we go. The market price of each peach and strawberry shares at the date of acquisition were for P 6 kwacha per share, for strawberry 3.25 kwacha per share. Now this price for the subsidiary they are giving you because they want you to use it to work out the NCI. It is not a decoration, yes. So here, yeah, for the subsidiary, this price is what you're going to use to work out the NCI. If they give you the price, then you know the NCI has not been given to you at fair value. You have to work it out. Or if they gave it to you, then that would be very fortunate. But I'll be surprised if they gave you at fair value because they've given the price. And now this one, if see the price for the parent is 6 kwacha per share. Now see the original price, the par value is 1 kwacha per share. You see, which means you've got a premium of how much? Of kwacha 5 per share. And that is where the share premium comes in. Yes. So what do you do now? That is why I thought we do this question before we go to the advanced questions, such as step of acquisition, joint ventures, statement of cash flows, consolidated, those ones. We need to do the basics. So before we go to the advanced financial reporting questions. So there we go. This is a good example. It's going to help us a lot. So what else have we been told? We've been told that on the same date, this guy acquired.
Sorry.
Yes.
Let me just ask this guy, volume,
okay,
sorry.
All right. Okay. Okay. Okay, so I was just explaining to him here that when you see a price for the subsidiary being given, then you think about NCI. You see a price for the parent being given, you think about share premium because the price is higher than the par value. The par value is 1 kwacha, but the price that's been given is 6 kwacha. But here is something else. On the same date, Peach acquired 30%, okay, of the equity shares of Apple at a cost of 7.5 kwacha per share in cash. So he also acquired an associate at this price, 7.5 kwacha per share in cash. Now for the associate, it is easier because there are no complications. Okay, you're back?
Hello?
Okay.
I'm back.
Okay, so
the spelling.
yeah, I was just explaining to the people who might be watching on Facebook. Yeah.
Okay.
So there we go. So we are saying that we are working with the group structure here. Now there's a share exchange. So where there's a share exchange, you should be happy because the question becomes much more easier. So now let's work them out. Let's follow it this way. Follow the English the way it comes. Don't confuse yourself. We've been told the pitch acquired how many shares? 36,000 shares. Okay, so we'll bring that one there. He acquired 36,000 shares. Have you seen in this company, the strawberry? By an exchange of how many shares? 2 shares. 2 shares in peach for every 4 shares in strawberry. 2 over 4. You see that? That's what's happening. He acquired 2 shares for every 4 shares in strawberry. Are you seeing? 2 for every 4 shares. That's how you work it out. At how much? At 6 kwacha per share. So you pick the price for the parent, the guy that is acquiring. Then multiply this one by how much? By 6 kwacha per share. So you're going to know the amount of money involved is going to be equal to how much? The amount of money involved now is going to be equal to, do you have a calculator there? Multiply 108. 100,000. Are you seeing? Now they've told you something else also. They've told you that when you did this, there's a plus 1.25 per acquired strawberry share in cash. You see that? He's also paying 1.25 per acquired share. How many shares did he acquire? He acquired 36,000 shares. Then we multiply by again 1.25 kwacha. So what is the total there?
It's
45,000.
45.
You see? So that means the total consideration this guy paid is how much? When you add the two, how much? 153? 153,000. That is the total consideration. So this figure here, the 153, is what you're coming to add the NCI. Then you remove the net assets, which will give you the goodwill at acquisition. And then you remove the impairment, which is going to give you the goodwill at report. That's how easy it is. But let's not get to that. I'm just showing you. We are going to do that one separate. So now, since we are done, remember we are dealing with the group structure here. We want to find out the group structure. So how do we know the percentage? Are you seeing? So we need to know the percentage of the group structure. So now we know there are 3 things involved. Let me just show you here what's happening here. So on our group structure, we're going to have something like this. We are going to have this guy, the parent. Obviously, we've got the parent here. We've got the subsidiary. So that's our parent, and that's our subsidiary. Then we also have the associate, that is Apple. Are you seeing? But what is important, you've not been taught the percentage. So we need to work out, for the associate, we know it is 30%. He acquired the 30% of this associate. Are you seeing? When? We know it was the 1st of April, 2014. You see? Even it was 1st of April, 2014. That's when he acquired. But what was the percentage? So how do you work out the percentage? We say acquired shares over total shares multiplied by 100. You get the percentage. So how many shares did he acquire in the subsidiary? He acquired 36,000 shares. Over, what was the total number of shares in the associate, in the subsidiary? Look at your screenshot. What was the total number of shares?
The total number of shares was 48,000.
Okay, there we go. 48,000 for the subsidiary. So we divide that into the 36 divided by the 48,000 multiplied by 100. So what was the percentage you're talking about? 75% sub. So here we know what this guy here is 75% subsidiary. Now we know that the NCI is how much? Is 25% NCI. What we don't control. That is our group structure there. You see? Now, every single time, Mr. Kafuti, once you do the group structure, please do what is called the consolidation adjustments. So now we are going to work out something called the consolidation what? Consolidation adjustments. Now, some students, they would love to go to the net asset list. They go to the Goodwill, then say, now you'll be coming back and forth. So for me, I love doing the consolidation adjustments first, and then I can now move on from the group structure to the net assets, to the Goodwill, NCI, retained earnings, and then investment in associates. So let's go. Working number 2. Now, working number 2, I can number 2, not the big 2. Aye. So this one, we are calling it investment in what? Investment in strawberry. That is the subsidiary. In the exam, write the full name, investment in strawberry. So what was the investment in strawberry? We are told that this guy acquired how many shares? He acquired 36,000 shares. Mommy, Mr. Kabu, just a minute. Mommy, come. He acquired investment in subsidiary. Okay. So now what's happening is he acquired the 6,000 shares. In a share exchange for how many shares? 2 for every 4. Are you seeing? At how much? At 6 quarter, which gave us 1,080,000. And then there was an addition, a cash payment of the same 36,000 shares at 1.25 quarter per share, which gave us 45,000. So the total consideration was 153,000. You see, that's our total consideration. Now, there's something I want to tell you here, Mr. Kaputi. This guy's par value was 1 quarter per share. Remember, 1 quarter per share. And if he acquired 36,000 shares, that means the share capital account is going to have how much money? It's going to have 36,000 kwacha. And then the other premium is a 5 kwacha per share, multiplied by the 36,000. We're going to have how much? How much 5 by 36?
It's 180.
Oh, wait a minute. Wait. We are fast. Let's remove this guy and remove this guy and remove this guy. Okay. I want to ask you a question. This guy acquired the 6,000 shares. In a short, 2 for every 4 shares. So how many shares did he actually acquire?
The number of shares he acquired, 18,000.
Excellent. So what this means that we simply get this 6,000, we multiply by 2 for every 4, which gives us how many shares? 18,000 shares. You see? So he actually acquired 18,000 shares. Are you seeing? So now what do? We multiply those 18,000 shares now, we multiply by how much? We multiply by 1 kwacha per share. That means we are going to have how much money? We are going to have 18,000 kwacha to the share capital in the SFP. Then the same 18 now multiplied by the premium, the 5 kwacha. We have how much?
90,000.
90,000. So 90,000 is going to share premium. So if you see, when you add those two, 90 plus 18, you have 108,000. And then 1 plus 6 plus 5, you have 6 kwacha per share. You see? When you say 18 plus 18, you have how much? 56,000 shares. So it should be able to show you that the formula is in line with your calculations here. Do you see this? This 108,000. My mona. Yapa so. 8 yapa. Mamona. 8 yapa. Mamona. And then this 6 kwacha per share. This 6 kwacha per share. My mona. Yapa. Yapa. But what we are doing, we are simply splitting this 6 to short. This 6 kwacha, 1 kwacha going to the par value. And then the other extra amount in premium. So this 90 goes to SFP share premium. This 118 goes to the SFP share capital. So what do? Go and deposit now to SFP. SFP share capital, we add what? Plus 18. You see? We say plus the 18,000. Which gives us a total now of how much? Of 138,000 share capital. Share premium, there's a working. Have you seen the working number 2? The exam is going to check there. You even include 90,000. That's how you post that one. Can be working investments in what? Investments in the subsidiary. Investment in the associate. So now we have investments in associate. Now the investment in associate is quite easy. We are going to work it out later on. Let's not work it out now. This one is easy because we know that this one, I think working number 3. Okay. We know that this kind of investment in associate is quite easy. We have the cost of investment. We are told here, look at this one here. The cost of investment in the associate, we are told the associate had how many shares also? At 48,000 shares. You see that? At 48,000 shares. And then what else do we have? Him, he was purchased at how much? At 7.5 kwacha per share in cash. What was the percentage? 30%. On the same date, P acquired 30% of the equity shares of the Apple at cost of 7.5 kwacha per share. So what did you get? 30% of 48,000. This one, multiplied by 7.5 kwacha per share. Okay, so what do? We go to the associate. We look at the investment associate. Usually, I love doing this per last year associate. So we're going to say the costs for the associate. The cost here was how much? Was it? We have 48,000 shares. We multiply by 30%. Then we multiply by 7.5. How much do we have? How much do we have, Mr. Kafuti? We have the same amount, 108,000. Okay, you see, that is the consideration investment in associate. Now, remember, we are going to have something called the parent share of what? P's share of profit, which is going to come later, so to recap also. And then if there will be any impairment, we'll remove the impairment also. And then we're going to have the investment in Apple come here. So we are coming back to this working, we are not done. For now, we know how much they paid for the associate. Have you seen that? They paid 108,000. Then we are going to know the total investment which they invested. So let's go to the other item that we need to look at. Other things we need to look at. Remember, so there we go. Other thing, go to note number 1. Is there something else we need to see? Okay, there we go. You see, we've been told that only the cash consideration, have you seen, of the above investments have been recorded by Fitch. So they are telling you this one was recorded, but the share exchange was not recorded. So they need you to work it out. Okay. Then in addition, 6,000 issue costs relating to the acquisition of Strawberry are also included in the cost of investment. 6,000 issue costs are included. So what this means is that, remember what we were talking about, what can make you buy at less than the fair value. Sometimes you may forget to account for this at issue costs. Then you think you've bought at a lower price, can't you've incurred other costs. So this figure here, we are going to reduce it from what? From the group retained earnings, the 6,000. It is a cost. It is an expense. We must reduce it at all costs. Don't forget that.
Okay.
Yes. So there we go. Group retained earnings. 6,000. Okay, let's go. So here the group accounts is a bonus in the exam. It's a bonus. Note number 1, what does it say? It says the retained earnings of Strawberry and Apple at 1st April 2014 as reported in their specified financial statements were 72 for Strawberry and 132 for Apple. Yes. Some people have got are very forgetful. So I advise in the exam, just bring it here per group structure. Say for the subsidiary of 72,000 group retained earnings. For the associate, you have 132,000. So you just don't forget retained earnings. Retained earnings. Okay, we put it there so that you just don't forget in case some people forget. Okay.
Yeah, and it's 132,000.
The other one is 132. The other one is 72. You just include it there. Okay. The reason why they are giving you this, they want you to come and use it to work out the net assets at acquisition. So, net assets at acquisition. So that you know whether there was a post-acquisition profit or not. PAP, to know the PAP. Already I know there was a PAP because they came with 72, but see, although the retained earnings at the close, they close with 106,800, you see? So already there is a PAP. So we're not working it out now. I prefer you do the consolidation adjustments first, then you come to if you are from a big 5 if you shall. Note number 2, We've been told there, not number 2. What have we been told? We've been told at the date of acquisition, strawberries plant had a fair value of how much? Of 40,000 in excess of its carrying amount. Okay, let's do the format here. Let's do the format. Let's do the format for the net assets so that we post some of these things already. Let's go. Let's say this guy is our net assets. Okay, let me just do another one. Okay, this guy is our net assets. Say working number 2, we have a net assets list. Now we have 3 things. We have at acquisition, at report, and then we have PAP, post acquisition profit. And this thing does not change. That's the beauty, Mr. Kaput. We have number 1 is always, it is share capital. We've got share capital, we've got share premium, we've got retained earnings. Now, the format is the same. We have what we call fair value adjustment, which comes with depreciation, excess dip. And then we have our URP. Sometimes there could be a brand here or an item of inventory which was forgotten. So you need to come and add them here. Okay. What was the share capital for at acquisition? We don't know, but we've been given the figure at report. At report, they had 48,000. So the assumption is that they also opened with 48,000 since nothing changed. Share premium, they had nothing. Retained earnings, we've been told at acquisition they had how much? They had 72,000. At report, they had how much? They had 106,800. Is that so? Is that so? How was the Singapore reporting? Oh, yes, there we go. That 106,800. You see that? Yes. So we have those figures. What else do we have? We need to find out now the fair value adjustment. Now remember the depreciation, it is always new here. At acquisition, you don't depreciate something when you're acquiring. No. URP, you don't do transaction when you're just acquiring a property. You leave it open. If you feel some kuba paso, next. But now we need the figure, fair value adjustment figure here. L35. Okay. So what do we do? Bring the pop a bit high here. Okay. So let's go back to the notes. We get out the fair value adjustment there. Okay, what is our fair value adjustment? Okay, I love this one. Okay, so the fair value adjustment, let's go. Note number 2. Yes, we have note number 2. Okay, we've been told at the date of acquisition, strawberry is planted at a fair value of 40,000 in excess. You see, of its carrying amount. So it is so. What they are telling you is this. They are telling you that the CV was lower by 40. Right? So in this case, it's like a good example could be if the CV, let's say if the fair value was 240, let's say fair value is equal to 240. Come on. Okay. If fair value is equal to 240, have you seen? That means the CV is equal to 200. Such that when you less, you have a gain of how much? Of 40. That's what they are telling you. At the time of acquisition, this guy had the payment of 40,000 in excess of its carrying amount. The CV was lower by 40. And at the remaining life of how much? Of 4 years. Straight line depreciation is used. All other tangible non-current assets at the fair value equal to their carrying value. So everything else was accounted for properly. So what this means is this. Remember, the fair value adjustment amount, the 40, don't change anything. The difference always goes to the net asset lists. The way it is, don't change it. So get the 40, post it here for net assets. Just bring the 40 there, put it 40,000. 40,000. Okay, now we have excess depreciation. What does that mean? It means that if an asset gains value, you see, an asset has gained some value. See, it has gained some value by 40, and the remaining life was how many years? Was 4 years. That means this asset should also suffer some depreciation. Are you seeing?
Oh, yeah.
Why? If the asset has gained some value, what this means is this, Mr. Kafut. It's like let's say you've been depreciating it at 20% per annum. Have you seen?
Mm.
So maybe the value was 200, and then you've been charging 20% of this asset per annum. But this asset is not 200, it is 240. Have you seen?
Mm.
That means you're undercharging depreciation because you are basing the 20% on the old value. Are you seeing? That means this extra value of 40 is not being depreciated. So DIP has been undercharged. Now, because DIP has been undercharged, it means PPE has been overstated.
Okay.
So you have to remove the DIP from this excess value to know the true value, the true gain. Are you seeing? So what is our true gain? Our true gain is going to be the 40,000 we divide by the number of years, which is the 4 years. Then we get the DIP of how much? Of 10,000. You see? So now we know the DIP is 10,000. Are you seeing? For 4 years. So now how the DIP is 10,000. So now how do you know? So now what you're going to know, what you're going to do is we're going to establish the real gain. So the real gain is going to be the 40,000 minus the 10,000, which gives us how much? The 30,000. This 30,000 is going to PPE, not the 40,000. Are you seeing? So what do? You now go and deposit. The 30,000 goes to PPE, the 10,000 goes to fair value adjustment, the 40,000 goes to fair value adjustment, and then the 10 is removed. Now let's show you how it's going to be done. So we are going to do something like this. First of all, we'll bring the 10 for DIP here to remove. Have you seen? We want to reduce the asset by 10. Are you seeing? So in other words, it's like we're simply saying this asset is not 40, it is 30, because we're removing the 10. Now go to SFP. Your SFP there, go to PPE, and PPE just increased by 30 plus 30,000, because that was the real gain. Or if you don't want it, you could have said plus 40 minus 10. If you're the kind of person that is interested in wasting time, you could have done that. But in the exam, no matter how tempted you are, don't waste time. Okay, so there we go. So we've posted that 30 there to increase our PP. So that was the true gain, is set. And then what do? We go to our net assets list. We include the 10, the DIP, to reduce the value. So in other words, we've just posted the 10. Are you seeing? We are showing that it was reverted to 40, but at the end of the year, there was DIP for 10, which would move. So the real value is now 30. Okay, let's go. Let's move on. Let's go back to the notes and find out something else that's going to help us. URP. So we're looking for our URP now. Unrealized profit. Okay, note number 3. Additionally there, Strawberry had an internally generated brand name. Boom. Finally, we have something. On the date Pitch acquired control over it, the directors of Pitch estimated the fair value of the brand name to be 12,000. You see, with indefinite life, and that it had not suffered any impairment. Now you see, Mr. Kafuti, what did we say in that example? That question for Goodwill, which we discussed earlier, and I said I did a video on Facebook. It is there on Goodwill. The reason why we calculate Goodwill, we calculate that we do Goodwill is because we want to see the true value of the company. Are you seeing? Now, this brand here has not been included at acquisition. That means Goodwill has been overstated. Are you seeing? When assets gain value, Goodwill loses value. So this asset has not been included there. So goodwill has been overstated. If not, sometimes incorrect calculations or maybe understatement of liabilities or incorrect valuation of what? Of the net assets fair value. So the net assets at fair value have not been valued properly because this brand name has not been included. So what do? We go and include it so that we show the true value of goodwill. Are you seeing? Huh? Because what this means by true value is this: if you remember in that farm, Amapesa sold that farm at 200 to Lusambo, 200,000 to Lusambo. Are you seeing? But the true value was how much? Was 100. So Mapesa had a goodwill of how much? Of 100. Now, if the 12,000 was forgotten, it means goodwill has been overstated, because if we add to the value of the net assets, it was going to be 112. Are you seeing? That means the goodwill is not going to be is not going to be 100. It was going to be 88. Hello? Hello?
Yes.
So we want to show the true value of goodwill. So what do? We add the 12,000, that brand. We bring it here. We have a brand. You see? So the brand now comes here, 12,000. We bring the brand. The brand is 12,000. 12,000. Okay, there we go. Let's go back.
2,000 on acquisition and also at reporting, because it doesn't suffer the impairment.
Yes, it doesn't suffer any impairment. Excellent. There was no impairment. Remember, intangible assets are not depreciated there. They are simply reviewed for impairment every year. So because it has not been impaired, we simply put a 12. Not number 4. Not number 4, we are being told here, on 1st April 2014, Pitch sold. The key statement here is Pitch sold. When the parent sells, you don't touch the net assets at acquisition. So what did he sell? He sold an item of plant to Strawberry, the subsidiary, at an agreed fair value of how much? Of 30,000. Its carrying amount prior to the sale was 24,000. Okay. The estimated remaining life of the plant at the date of sale was 5 years, straight line depreciation. Now, there is English here in this question, Mr. Gafut. And if you miss this English, this one is not URP. You see, it is not URP. It is what? There are two things happening here. There is revaluation happening here, and there is fair value. They've told you sold at an agreed fair value. So these assets were revalued from 24 to 30. That's what happened before he sold. And then after being revalued, he said, now, let me sell to you at the same revalued amount. Are you seeing? So here there's a fair value working. Now, what this means is that we are going to have something called depreciation, excess depreciation. Yes. We're going to have something called excess depreciation. So here we have two things. We're going to have URP, and then we're going to have DIP, excess depreciation. Because two things have happened. So if you don't understand the English here, you are gone. Because it was sold at an agreed fair value. That's why they've given you the number of years. So what do? We simply get the 30,000 minus the 24,000, which gives us the 6,000. Now, this 6,000 is your RP and realized profit. Are you seeing? What this figure is going to do is going to reduce debit what? Group retained earnings by that figure. Are you seeing? And then what else do we do? Now, because it was a revaluation, this plant was revalued from 24 to 30. Am I not just awesome, Mr. Gafut? I feel good about this working, because this English here, somebody can simply get the URP and move on. and think it was a normal sale. It wasn't a normal sale. It was a revalued sale.
So it's different from a normal sale.
It's different from a normal sale. Yes, like they revalued the net assets from 24 to 30. So after being revalued, this other guy showed interest. Yeah, but now he planned to pay the new value. Are you seeing? It is not like they just said, give us so much because they didn't add the markup. There was no markup here.
Okay.
It was just a revalued amount, agreed fair value amount. That's how beautiful this statement was. So what do we do now? We have the figure 6 to reduce our group retained earnings. We are going to reduce. Now what do? We're also going to charge what? We are going to charge excess dip for how many years? For 5 years. You see that? So we divide this by 5 years, which gives us how much? 1,200. Are you seeing? Now this 1,200 is going to do what? It's excess dip. It's going to increase our group retained earnings. We're going to credit our group retained earnings. So let's go. Let's find post. So if this was a working, it would come here. Those are, remember, those are consolidation adjustments. Huh? Yeah. So aka number 4, ka working number 4 can be aka nono. Ka number 3, naka number 4. Kashinga kabaso. We are saying URP. And then here we have the parent selling. Parent sold. Sold how much? We sold the cost of the item. We sold where? 20. We are 30. Now, let's say this was not the cost. This was the fair value. Yeah? Let's not do it cost, let's do it fair value. So the fair value was 30, and then the CV was 24. So there was some gain of how much? Of 6,000, of which the economic useful life for this particular asset was 5 years. Then we had excess dip of how much? Of 1,200. Now, what did we say? Here we said something here. We said that this one is the URP. We are going to debit our group retained earnings. This one is excess dip. We are going to credit our group retained earnings. So what this means that we are going to remove the 6,000 from the profit and add back the what? The 1,200. What this means is this: if we remove 6,000, this 6,000 already has how much? Already has 1,200 inside. So if we also remove the excess dip of 1,200, it means we are going to remove how much? We are going to remove 7,200, which we've over removed. So what we do? Simply remove the 6 and then add back the 1, 2. So in other words, what we are saying that if we get the 6,000, we remove the 1, 2, you're going to have 4,800. So if you remove 4,800 and then you also remove 1, 2, it means you've removed 6,000. Mamonai. Hello? Hello?
Yeah, yes.
Hey. You are delaying to respond, Mr. Kaput. What's happening?
Nde wika kumute wale pange chongo.
Oh, abana wale pange chongo. Oh, okay. All right, okay. I understand. Okay, so to us working here, what do we do now? These ones, they don't affect the net asset lists. Why? Because P sold. Have you seen? Parent sold. Remember, when the parent sells, don't touch the net assets list, the net assets. Okay, and another thing, note number 5. What do we have on note number 5? We've been told during the year, we said first March, the date is always important. Strawberry sold goods, wow. The keyword is strawberry sold. Who is selling here now? The guy who is selling is the subsidiary. Have you seen?
Yes.
Now, this is going to affect the net assets at acquisition because the sub is selling to pitch for how much? Was it 2,400? Have you seen that? Strawberry had marked up these goods by 50% on costs. You see? 50% on cost. Pitch had 1/3 of these goods still in its inventories at the 1st March 2015. Oh yeah, good. There's a small story here, Mr. Kafuti. We are being told something here. The sub sold. So simply think about it, net assets at acquisition, because the sub sold. Now we've been told he sold goods. The goods were worth how much? The goods were worth 32,400. What was the markup? The markup was 50%. 50 over 150. Are you seeing that? So when we multiply the 50,
you sold for how much? Let's see. The first letters, what's this?
During the year ended, Strawberry sold goods to Peach for 32,400.
Okay.
Now Strawberry had marked up these goods by 50% on costs. So the markup was 50% on cost. Are you seeing? So how do we work out the markup? The markup is 50 over 150. That's the fraction for the markup. We multiply by the 2,400 to get how much? To get what you're going to call 3,600. Have you seen? Now there's a problem here, Mr. Kafuti. Usually we could have gone to URP and removed the 3,600, but we're not going to do that. Why? Because we've been told the Peach sold 1/3 of the goods. Peach had 1/3 of the goods still in inventory, meaning when Peach bought from the subsidiary, he sold the rest. He only remained with what? With 1/3. That means if you buy from your subsidiary, then you sell to someone else, the profit you're going to make on someone else is genuine. Are you seeing? You're not going to remove it. But the profit you're going to make on the subsidiary or on the parent is not genuine. You can't sell it yourself. Have you seen that?
Okay.
It's like that example we gave where the wife says, "My dear husband, you're so wonderful. I want to pay you for being a wonderful husband." Then what does she do? She goes to your joint account. In your joint account, there's 100,000. Your wife withdraws a 10,000 and pays you for being a wonderful husband. So, 90,000. Now, what do you do? When you get this money and take it back to deposit in the joint account, how much money are you going to have? You still have 100,000. That means your wife has not given you anything, because in the first place, the money she's given you is from your own account. I see. Yes. That's why we say URP, unrealized profit. You can't make profit on yourself. But if your wife gets money from somewhere else and pays you for being a wonderful husband, the joint account has got 100,000. She gets 10,000 from someone, she pays you. When you deposit, you're going to have 110. That means you've made some money. Are you seeing? Yes. Now here, what we are saying is that he remained with 1/3 of the goods in inventory. That means the others he sold, it's okay. So we're going to multiply this 3,600 by 1/3. How much is that? How much is that when you multiply?
1/3 times 3/6. It's 1/2.
Are you sure?
3/6 times 1/3.
No, wait. Are we multiplied properly? Tell me, when you multiply 3,4, multiply by 2,400 multiplied by 50 over 150, how much are you getting?
1050 over 150. 10,800.
Okay. So you have got working up. You have another working. Number 5. That is it. We continue. Okay, we're still on new RP here. We are still on new RP. It's not working number. We are simply going to say sub sold. This time around it's S sold. S sold. You sold goods. Cost now was 32. Was 32,400? Huh?
Yes.
We sold goods of 32,400, and the markup was 50%. So it remained with 1/3 in his inventories. Huh? Remember, when you multiply by that, you have 10 what?
800.
10,800. When you multiply by the 1/3 in inventories, which gives you 3,600. That's the figure that goes to the net assets at acquisition. You're going to reduce the net assets by this figure. But I'm going to reduce. So to make it easier, I could have simply done 32,400 multiplied by 50 over 150, that markup, multiplied by 1/3, which is equal to 3,600. So let's go to our net assets and then complete it. So we have now 3,600 there because the sub sold. So our net assets is now complete. So we make our totals now. Remember, we are racing this guy minus this guy. We have new here. This guy, no, this one. 72,000 minus 106,800. How much do we have here? Want to come up with our post-acquisition profit. How much we have?
Negative 34,800.
It is not negative. Just get the difference.
34,800. 34,800.
Are you sure the difference is 34? When you say 106,800 minus 72?
72,000 minus 106,800 is 34,800.
Okay, so we have a figure here called 34,800. Okay, 34,800. This guy minus this guy, we have new integers. Integers. 0 minus -10.
It's 10.
It's 10. So if we say -0 minus -10, then we're going to have -10. So this one, we bring it there as the 10,000. Okay. This guy, we bring in there. These are just integers. There we have new, so we have the total. So what's our total PAP? What's our PAP here?
34,800
minus 10, that is 24,800 minus 36, that is 21,200. Then here, this guy plus this guy plus this guy plus that guy. How much do we have? How much?
That's 161,200.
Are you sure, Mr. Kafuti?
Oh, sorry, the brand had put at 1,2, sorry.
It's 12,000. This guy is 12,000. How much do you have?
172,000.
Okay. So there we go. There we go. Now, as you know, this figure here is going to be used to work out our goodwill. We have goodwill. You see? And then this figure here is going to be used to work out our NCI. Remember, our NCI is how much? It's 25%. We multiply by 25%. Are you seeing? And then it's also going to be used to work out our group retained earnings. Group retained earnings. Why? Because what we control is 80%. So we're going to multiply this figure by 80% to know the share of the parent on the post-tax profit. And we'll multiply this figure by 25% to know the share of the what we run controlling from that profit.
How was it 75%?
Oh no, oh no. What's our NCI? What's
75.
our 75%? Oh, there we go. There. Okay, 75%. Good. So we are multiplying by 75%, not 80%. Yeah. Thank you. So we have 75%. Oh yeah, yes. Okay. Let's go to other workings. Let's go. So at this level, you are even happy. Group accounts is just about English and just being able to know which one comes after which one.
Mm-hmm.
Now, here we are being told something here. Peach or strawberry 85. Have you seen at the 1st March 2015 for some of the goods strawberry have supplied during the year?
Mm-hmm.
Remember, you cannot owe yourself.
Mm-hmm.
You can't owe yourself. You cannot owe yourself. Takwaba. If you don't believe me, please ask a sole trader. They will tell you. You can't owe yourself. So what do we do? The double entries, you simply go to receivables, reduce receivables. So credit receivables and then debit payables. To reduce the payables, you debit. To reduce the receivables, you credit. So you're crediting because you want to reduce. You're debiting because you want to reduce. So what do you do? Simply go to the SFP and immediately do that. That's the beauty of writing the SFP in advance. Because you're simply going to rush to the SFP there. And what do you do? Go to receivables. Where is our receivables? There we go. We're going to reduce. Remove that 85. Remove the 8,500. You can't owe yourself. Go to payables. Now see, we don't have payables here, but we've got current liabilities. Payables is always part of current liabilities. So come and reduce the 85 from here. Okay.
Sorry. Just a minute. Where is my paper?
Mm-hmm.
Just give me a second. A second. What has happened? Someone has taken my SFP. Okay, I have it.
You have it? Okay, so let's go. So you just post there, remove.
That's the double entry.
Reduce the receivables, reduce the payables. You can't owe yourself. So stop overstating things. Okay, let's go back to the other note.
85.
There we go. So we've got note number 7. The other investments are included in PC statement of financial position above at their fair value on 1st April 2014. Okay. So in the SFP, that's the fair value at acquisition. They are the fair value of 108. Are you seeing? At the 1st March 2015. So at the date of report, they are the fair value of how much of 108. So they gained some value. See? What we are being told that other investments here, these investments, we're being told that other investment was 78. You see? At acquisition. But now we've been told at the date of report, the fair value was how much now? The fair value was now 108. What that means is that there was a gain. 108 minus 78,000, we have something called 30,000. So 30,000 was the gain on other investments. What do you do? Simply show it in SFP, there was a 30,000 gain. So go other investments. What do you have of 78 plus 30,000? The gain, have you seen her? This guy is a gain, which gives us a total of how much? Of 108,000. All of us, have you seen what they do in their questions? They put some answers there, Palana. So that a student who has weaker principles, who has a weaker understanding of principles, is going to be scared that maybe he have made a mistake.
Yeah.
There's too much 108 popping up to confuse a weak student. But the legends, they just post and move on. They don't care whether it balances or not. Don't try to balance the question. Just post and move on. Stop totaling. Legends don't total things. They just post and move on. Pitch as a policy of valuing and controlling interests at fair value at the date of acquisition. For this purpose, the share price of strawberry at the date of acquisition should be used. You see what we said? We said when they give you the share price for the subsidiary, it is not a decoration. So they have this policy. NCI should be valued at fair value at the date of acquisition. Fair value. So what do we do? Let's go. What was our NCI? We are told that the strawberries share prices were how much? We are 48,000. Are you seeing? And from that 48,000, what percentage don't we control?
25.
We don't control 25% definitely. You see? So what do we do with what we don't control? We simply get the 48,000. Now, before I go there, let me just show you something here. Before I go there, let me just show this guy. See, we've been told the share price should be used there. What was the share price at acquisition for the subsidiary? We are told the share price was that guy there. You see, 3.25 kwacha per share of the share price. So that's the price we're going to use. Okay, so there we go. We get our 48,000. We get our 48,000. For our 48,000 there, the number of shares in this company multiplied by what we don't control, the 25%, that's NCI, and then multiplied by the price 3.25 kwacha per share. How much do we have? How much is our NCI?
23 by 0.25 by 3.25. Hey. 48.
How much is our NCI?
39 pin.
We have 59,000. This figure is going to help us to calculate our goodwill. We are going to add this figure to consideration. Have you seen? And then we are going to remove the net assets at acquisition to get our goodwill. That's the cost of that figure, 39,000. Okay, we've been told that no dividends were paid during the year, so this is good. No dividends were paid during the year. We even say thank you so much, dear examiner. But the examiner knows it usually comes under group accounts. It reduces the group retained earnings.
Oh.
You pay dividends from the cash. Now, here where the problem comes in. If you overstated your goodwill, there's a problem. Because you pay dividends from the group retained earnings. So it's going to reduce our group retained earnings if dividends were paid. You subtract from the group retained earnings. Oh, here.
At acquisition.
No, group retained earnings just at the end, the covered acquisition. Just at the
Also,
end.
we started reports.
By reporting. An impairment test on 31st March 2015 showed that the recoverable amount of gross goodwill in respect of strawberry is 15,000. We are done. So let's go to work out our things now. Let's go to work out our things. So recoverable amount is 15,000. Okay. Let's go. That is another good English to to remember. Chisungu should give it up. So what do we have? We have our NCI. So let's look at our goodwill. Now remember, our goodwill is going to be working number 3. So we have working number 3, a big 3, which is goodwill. Now, goodwill is always straightforward, as you know. If you are partial, we have consideration. What is our consideration for goodwill? We had 2. Remember, we had the share exchange.
Yes.
We had the share exchange, which was how much? Which was 108. 108,000. And then we had cash, which was 45,000. You remember?
Yes.
There. The share exchange, there we go, 108,000. That figure there. And then we had the cash, 45,000. Total, 153. If you want, you would have just brought the total consideration. But the reason why I'm bringing them in separate, because just in case you messed up something here, at least get a mark for an entry, for a correct entry. Yeah. That's why I'm bringing them like that. So what we do, we are going to add NCI at what? At fair value. What's the NCI at fair value? We found that it is 39,000. What's our total figure there? 108 plus this one, it was 153. 153 plus 30, yabana 183 plus 9.
192.
192. Okay. So are you sure it's 192?
Yes.
I'm not using the calculator. 192,000. So that 192,000. Remember what we said? We said to work out our goodwill, we are going to need a figure, and the figure we're going to need is this guy here. This guy, the 172, to remove from the total consideration. So we bring now net assets at acquisition. You see? So now we say our net assets at acquisition. How much? 172,000. So we remove, then we have our goodwill. Now look at it this way. So what is our goodwill here? 20 is our goodwill.
20,000.
Was there any impairment? Let's go back to the question. Was there any impairment? What was the impairment? 15,000. Okay. Now here, Mr. Kafuti, we said English should be able to work. Have you said this 15 is not an impairment? That's why the examiner plays with students. It is the recoverable. The recoverable amount of gross goodwill in respect of strawberry was 15,000. Are you seeing? That means the impairment was how much? Was 5,000.
That's it?
This 15 is not an impairment, it's a recoverable. What we're able to recover at the end of everything is 15,000.
Oh, from the goodwill.
Yes. So now let's go to our working there. See what you've got. What do we have? We have, when we list that one, we are going to have something called goodwill at the report. Have you seen it? We are going to have goodwill at the report of how much? Of 20,000. Oh, goodwill at acquisition. So now we have our goodwill at acquisition there of 20,000. So the impairment here for goodwill is how much? Because we've been told at report, we have goodwill at report here. We've been told that the goodwill at report, what we're able to recover is how much? Is 15,000. Have you seen that? That's our recoverable. So the difference between our recoverable and what we had at acquisition is 5,000. So 5,000 was the impairment loss on goodwill. Let's get back to that. That's English. An impairment test on 31st December 2015 was taken. But date of report, see, we're reporting when at 31st. An impairment test was taken showed that the recoverable amount of gross goodwill in respect of strawberry was 15. So they're able to recover only 15 at report. 15. So students are used to being told the goodwill was impaired by 15,000 or by so and so. So they just list it. But this case, the examiner told you the actual figure and didn't tell the impairment. So you have to be careful in the exam. So what do we do? The recoverable is this guy. So this is what we are calling the recoverable. Recoverable. That's our recoverable figure. It is the figure that goes to the SFP. So what do? You simply go and post to SFP.
Where did that
working number 4?
Where did that figure go? The one we did on the working number when we were doing the net asset list. There was a figure for 21,200. Then you said we'll use it.
I've not yet reached this stage. It's going to work out our NCI and also our group retained earnings. Now, when you say NCI, we're not talking about NCI at fair value. No, we're talking about percentage of the NCI's profit. The total profit is how much? Is 21,200. So NCI is going to get 25%. Group is going to get how much? 75%. Yes. So there we go with our group. Our impairment losses there. So we've posted safety 15. Okay. Anything else? We work out our NCI. Working number 4. Non-controlling interest. Boom. There we go. Okay. What was the NCI at fair value? We've worked it out already. We even working number 3. Say working number 3. For goodwill up. We simply got the 48,000. We multiplied by the 25%, and then we multiplied by 3.25, and we got the 39. So there we go. We have our 39,000 right there. We have our 39. That was our NCI at fair value. Now we're going to say NCI percentage of PAP. You see now? The total number that the time has come. NCI percentage of PAP. What is our PAP? Post-acquisition profit. This guy here. You see? The 21,200. The NCI percentage is 25%. So they get their share. So we're going to say NCI percentage of how much? So we're going to say 21,200. We're going to say that 21,200. The 21,200. We multiply that by the 25%. What is the NCI percentage of that?
The value?
Yeah, what's the value?
5,300.
5,300?
Yes.
Okay, so we have our 5,300. 300. You see? So when you add, what's our total? Our total there is 44,300. Not so.
Yes.
Now remember, the NCI, thank you very much. Just there. Okay, thank you very much. Okay, I'll do so. I'll do so. Okay. I've just been saved some wonderful breakfast.
Okay.
So we'll take a short break. I have some breakfast, then we are going to continue.
No
After
problem.
we're done with this question, we'll take a break. I have some breakfast and also rest a bit, then we continue. Since we are going up to 11 now, we are doing 4 hours today. Okay, so let's go. There we go. So we have that figure there. What else do we have? We are going to say impairment. No, the NCI also should suffer the impairment. Have you seen?
Okay.
So what was the goodwill impairment? So NCI should also suffer the impairment because they're also enjoying the profit. So even the losses, they are supposed to enjoy or to also share the losses. So what do we do? We are going to get the impairment loss of 5,000 multiplied by 25%. So the impairment is 5,000 multiplied by how much? Multiplied by 25%. So how much do we have? How much do we have?
450.
How much?
1,250.
1,250. So when we less the impairment from the NCI, what's the NCI at report? Remember, this was the NCI at acquisition, this figure. Acquisition. Now, what is at report? NCI at report.
No, you know, the acquisition.
What's our NCI at report now?
Minus 44,300.
Is it 43 something?
43,050.
43?
1,050. 43,050.
Okay, so this guy goes to the SFP, NCI. So what do we do? We post. Remember what we did there? NCI comes after equity. You leave a line here, power line package up, and then the NCI should come here. NCI. Don't mix the NCI with the reserves.
Okay.
NCI should come there. Leave a line. If you combine the NCI with the reserves, even prepare for the 18 exam because we don't know the principle. So we have 43,050. 43,050. That's our NCI. Anything else that we need to work out? Yes, we need to work out now our group retained earnings. There we go. Now, group retained earnings is working number 5. Our group retained earnings. Now, here we have a few things. We have parent who is a pitch. So we've got the pitch guy here. We've got the subsidiary, the straw guy. And then we've got the associate, the apple guy. You see? And always it starts with the same statement per question. So what is our retained earnings per question?
Okay.
So per question, we simply go back to our SFP. We get the figures from our SFP. So from our SFP there, if we go back to our SFP, we should be able to get some figures there. So what were retained earnings? The parent at how much? See that? 303. The subsidiary at how much? 106. The associate at how much? 192. You see 192 has popped up again to confuse students. So you have 303, 106, 800, and 192. Then you go and post those accordingly. But the parent came with 303. The subsidiary 106,800. They associate 192,000. Okay, now remember what we said. The reason why we wake up the PAP for the subsidiary, not Sangakari, profit, not Sangakari. So what do we do for the subsidiary? We've worked out already. We simply go and paste, copy and paste this guy. You see? We've already worked out for the subsidiary. So we're just coming to copy and paste this guy. We are copying and pasting this guy. You see? We copy and paste. So we remove the 72 at acquisition, this guy. And then we remove the 10, and then we remove the 36, which we've done already here. We simply copy and paste this figure. So what do? We simply go there and paste. So we have, or if you want, you can simply put working number 2 and simply write PAP and copy it here. So simply say at acquisition. So at acquisition, they are 72. You see here? This guy at acquisition, they are 72. So now what was 72,000? Are you seeing? We remove, and then we had fair value adjustment. No, not that one. We had excess dip. We had excess dip. Remember that dip? The dip was 10,000, and then we had URP. It was 3,600. So what did we have? We had the total of 21,200. That's the total there. 21,200. So we have the 21,200. But here we had 132. Is it 132? Yes. When we remove the 132, we have how much? How much is 60? Well, we remove of 60,000. Associate. Associate is always is. So now we have that. So now we come to the parent. Now remember, for the parent, there was a point where the parent sold. You remember? The parent sold to the subsidiary something here. URP. P sold. You see this guy? So we said we are going to remove the 6,000 from the parent and then add back the 1,200. Are you seeing? So URP. So URP, we have URP for the parent. So we say URP. Now this URP for the parent, we have also URP. Have you seen? We have for the subsidiary that one, and for the parent was 6,000. So we remove the 6,000 for the parent. And then depreciation, we also had for the parent, that 1,200. So we're removing the 6,000 and adding back the 1,200. Okay, what else do we have for the parent? Yes, we have something else for the parents. We had that gain. Remember the gain on investment, gain on other investments. That gain was 30,000. We added back. We posted the ODM SFP. This gain, you see, that was 30,000. So we are going to post that one here. Apa even relaxed. Mwasoba na pesa Mr. Kafuti. Where are you behind, Mr. Kafuti? Where are you behind?
Okay, where? So Apple. So for Apple, it's 2,000 if you finish Apple.
21,200.
Strawberry, push up.
For so Apple, the price of 192, but they came with how much? Remember what they came with? If you get to remember, but just in case you forget, you wanted to. The one they came with, retained earnings at acquisition. So we simply less what they reported is 192. What they came with 132. Meaning they made a profit of how much during the 60,000. Yes. For the subsidiary, not just copy and paste. Now we are simply saying, since the parent sold something during the year, we said you're going to debit group retained earnings by 6,000 to reduce it, and also credit by 1,200 to increase it. Remember? So we simply bring now this. You see, we are simply posting now. We're not looking on. So the 6,000 a year per toilet per twi poster. 6,000 twi poster. We remove. The 1-2 depreciation in there a year per. We add it. Then gain on other investment. So there was a gain in the notes. Remember that gain we posted it here 30,000. This was a gain. We are told about this gain in the notes. We are told about that gain in the notes. But there was a gain. Yeah. Which statement financial position above what the fair value in 1st April 2014. They are the fair value of 108. The other investments here. You see? The fair value was 108. That means the gain was how much? If we go to SFP, the other investments were 30. They were 78, that figure there. Minus 108, we get a 30. That was the gain. So we remove 108, which gave us a 30. Now, this is a gain. It's going to increase our retained earnings. Our profits should go up because we've gained. So, twice add. So, yes, this is the 30,000 gain. We add it back. Okay. Is there anything else? Okay. Are you okay now? Where this 30 is coming from?
Yes. Again.
So we can move on?
Yes.
Okay. So now, what else do we have? Remember something else? There was some issue costs. If you don't count properly, you can think you bought at a price lower than the fair value, can't you? Costs. This cost, the 6,000. So in the exam, by the item, highlight and write what things are supposed to go in the question. On the cash position was China. So in addition, there was the 6,000 issue costs. This guy, this was an issue cost, the 6,000. So we're going to reduce the profit because it was a cost. So you have to remember, label your workings properly so that you don't. So we simply say issue costs. So the issue costs should be reduced because those are expenses. We remove the 6,000. Okay, what else do we have? We've removed the 6, another 6, we've added the 1, 2, and the 30. So there's nothing else now. So now we have the total now. What's our total retained earnings? No, we're not done yet. We're not yet done. We need to get the share. Remember what we said? We said there's going to be a share of profits. Huh? Here. You're going to have a share of profits. The parent should be able to get, remember this figure was said, the parent is going to get 75%. Huh?
Oh, yeah.
And then the NCI was 25%, the parent. Then we parent full to so good subsidiary associate, but control the percent. 30%. As you see. So share of profits. So we have number 1 for sub. For sub, Bunishinga to send the co-profit to our parent. Not quarter 21, 200. That 200 multiplied by 75%. So what's our share as a parent?
59.
How much?
15,900.
59. Subsidiary for associate by 60,000 multiplied by the 30%. How much is that? 18. Okay. Now remember, the NCI has suffered impairment. You see, they got their share from the impairment, that one. The parent has not yet gotten their share from that impairment loss. So what do? The parent should also get the impairment loss. So impairment. What was our impairment? It was 5,000. Multiplied by our controlling interest of how much? Of 75%. How much do we have? 3,750. We'll remove that figure there. So now what is our total profit number to the SFP? What is our total profit? What is our total profit?
Mm, 352,350.
So we've got our total profit of 352,350. 352,350. So how do you say that as an accountant? It's 352,000, 350 kwacha SFP. For equity, layer. So what do you do? You even go to SFP and post retained earnings, working number 5. Mwalemba nokolemba nishinga 352,350. Okay, we have one more thing to do. Remember investments.
Wait. 138. Retained earnings and 9. What? I write that too. Yes, sir.
Okay. So there we go. So we have one more thing. Remember, there's a line remaining here, investments in. So in Apple here, we need the figure there. So what do we do? Let's work out the investment in Apple now. So twachamba no kuyamba investment in Apple. Remember, twachamba yapa. Remember, yapa investment twachamba in. Okay. So now we have the figures now in place. We said P's share of profit from no. Now we're getting associate share of profit. Now their share of profit number. We said we wrote P. Okay, we say their share of profit there. So what do we say? We say now, what was their profit? Their profit was 60,000. Have you seen that? Share of profit. This profit was 60,000. From that 60,000, they control 60%. If we don't, the associate has the 60% here. Have you seen that? Hello?
60% from what?
The associate, what we don't control is 60%. Our share of profit, P's share of profit.
Also, we've got the percentage of 30.
30, yes. What we don't control is 60. So you're going just to get that 60,000.
That's 20%.
Wait, Mr. Kafuti. They have 60,000 profit, these guys. Are we okay on that one?
Yes.
What we don't control is 70%. What we control, what we have influence over is how much is 30%. So you're going to get the P's share of what? Of this profit. What is that? The profit is, the P's share is going to be how much? So P's share is going to be 60,000 multiplied by the 30%.
Yeah.
You're going to have how much?
18 on 8, that is 18,000.
We are going to have 18,000. $108 plus 18,000.
126,000.
So we have 126,000. Let me just move this one. So we are going to have now 126. So this guy we have 126,000. And now impairment, we have 0. This guy does not suffer impairment. So what do? We have investment is how much? 26,000 in associate. So if you wanted, you could have worked, you could have called it working number 6 and said investments in Apple. So we could have said consideration for Apple, we paid, it was 48,000 shares multiplied by the 30% which we control, or which we have influence over, then multiplied by the 7.5, and then we got how much? We got our 108. Then we said P's share of profits, which we simply get the 60,000 multiplied by the 30% which we have influence over, we get our 18,000. When we add, we have 126,000. Then we list the impairment because the associate has not been impaired, we have nil there. So the investment in associate is how much? Is 126. This is the figure that is going to go to our SFP at report. So we even go and post there. Here we go. Yes. Working number. We can even call it working number 6. Let's just say working number 6 anyway. That is the 126,000. Nishama working is going to say more pusher. So we begin to add now. This guy plus that guy. How much figure do we have there? So on intangible assets, wait. Remember what we said? We said leave a line. Remember, intangible assets, we had something that they forgot to add. They forgot to add something here. Remember, they forgot to add the brand, this 12,000. This guy should appear in the SFP to show the true value. So intangible assets, what do? We say brand. So we bring the brand there. Was how much? Was 12,000. So now we add inventories. What is the total for inventories when you add? Now, here's something I want to show you. Remember, inventories, we're not making a total because of one thing. We have what we are calling URP. Are you seeing? URP. See this working here? The URP. The subsidiary is sold. There's this one, we said it was going to go to net asset list, but at the same time, it was going to reduce what? Reduce inventories. Group inventories. You can't sell to yourself. So this inventory should be reduced from the group because they were already there to start to begin with. Are you seeing? Hello? Mr. Kaputi?
Yes.
You're saying reduce this. So they were already there. So the 36 should be able to reduce your inventories in the SFP. So the inventories now we're removing what? We're removing the 36 RP. That's working number what? It's like a small working, It's like a small working number 3. Working number 3. So even include the small working there. Working number 3. So when you less there, how much do you have? You have 153,600.
82,800 plus 74.
Payables when you less, receivables when you less, how much do you have?
3,600.
You have 47,900.
3,400.
Then here you have those ones, you have new. Ukuna, when you add those two, 60 plus 12, that's 72,000. There, when you less, how much do you have?
100. Wait.
Current liabilities,
So
when you raise, what's the total?
now,
What's the total for current liabilities?
current liabilities, wait, 96,000 plus 5,400 minus 85, 137,900.
137,900. So there we have 137,900. Okay. So there we go. So that means this question. So now we worked out anything. So just before you go, it is always nice. It is always nice to simply show. So kindly turn on your camera. So I just explain a few things to you. It's always nice to show.
You finished the
Yeah,
139,700.
yeah, 13700. Yeah, so this one is done. You can turn on your camera. So we are going to go on a breaker. Break. So I have my breakfast for about let's take 15 minutes break. If you are watching us from Facebook, simply call 0953. Turn on your camera 979798. And yes. Okay, so there we go. So Mr. Kafuti, we are going to come back later. What's the time now? Now it's 9:36, sir. So we're going to come back at 9:51. We're resuming at 09:51 after 15 minutes. So please, what I want you to do now, I want you to now go through what we've talked about and see the bits and pieces, the matrix, the English and everything like that. Do you have any questions before we go from what you've looked at?
Like you said, I think for me it's just to have enough time to go through now to put the bits and pieces together. Like I made mention previous when we just started, I think for me, what has been the biggest challenge is the lapse from the time I did my financial reporting and when I started doing my SPR.
Okay.
If there
So do you
wasn't a big
have any challenge on these ones from what you've looked at today?
it's just no. It's to practice, like to go through to understand the bits and pieces.
Okay, all right. So now, please go through. Then we are going to continue. Now, what we are coming to do next, we are now going to the advanced part. We are coming to start now what we are going to call step up acquisition. So now we are coming to step up acquisition. Then from these ones, we are going to go to discontinued operations. We are going to go to those joint ventures, and then we are going to end with cash flows. Not today, but today we are going to deal with step up acquisitions. And then when we meet next, we are going to deal with discontinued operations, and then we're going to go to statements of cash flows, consolidated statements of cash flows. So for now, let's prepare. Now my time has even gone. This is 0938. So if we add 15 minutes on that one, we are going to have that is 48:53. So now we are resuming at 9:53.
Okay. I can also have my breakfast, so I have enough energy.
Okay, you can have your breakfast. Okay, let's say let's resume at 10 hours then.
10. Okay.
We take 20 minutes.
All right.
I think that would be too much. Huh? Let's take 15 minutes. Let's resume at 09:55.
Okay.
Okay. Thank you very much, Mr. Kafuti. We'll see you at exactly 09:55. So
Should
now,
I still keep on the camera?
no, let me just cancel this session. When you are done, when I'm done, I'll give you a text message on WhatsApp. I'll give you a message on
Okay.
WhatsApp. So for
Okay.
now, we go. Bye-bye.
Bye.